with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, June 5th, 2026. Some big shout outs to Jeff and Lucy, Brian, John. Hey, how about a big shout out to my mom, putting up with me for 53 years this week. And let me tell you something, that's not easy. Well, it was not easy all the time. And you know what else is not easy all the time? The stock market. Not easy all the time. And it was a rough ride this week. So let me go ahead and jump in and tell you what the numbers look like this week. So all the major indices were down. And actually, all of it happened today. Today was the beat down day. Dow Jones down 1.35% this week. The S&P 500 down 2.59%. The S&P 500 down 4.68%. And the Russell Small Cap Index down 2.9%. So all the major indices down. I mean, the big ones, S&P, NASDAQ, 3 to 2.5 to 5% in a single week. And it almost all happened today on Friday. The S&P was down 2.6% today. Major move lower. And I'll tell you why here in just a moment. As you might expect, the volatility index went up quite a bit. It was up 40% on the week, finishing the week at a 21.5. So still on the low end in the whole scheme of things. They can go much higher. Long-term bonds as measured by the TLT, they too were down this week. They were down about 0.8% this week as rates went higher. And again, most of that happened today as well. I'll discuss the whys here in just a moment. Looking at the different sectors out there and how everything's looking in regards to the sectors, the only standout that I thought was interesting was financials. Financials did well this week, up 1.4%. And it's really not a defensive area. And I think what really drove the financials higher is the fact that all these IPOs are coming to the market, and the market's expecting these big banks that are doing the deals to make a ton of money on these. Aside from the banks, it was really the defensive areas of the market that did well. Consumer staples were up 0.5%. Energy up 2.45%. Look, if you remember last week's podcast, the war in Iran was coming to an end. Everything was looking great. Everything's going to be wonderful. Everything's going to wrap up. And then the beginning of the week, Iran says, we're out. We're no longer talking, and we're shutting down the Strait of Hormuz. And of course, oil spiked up again. Energy was up 2.4% on the week. Healthcare also up 2.4%. That tends to be very defensive, as were consumer staples up 0.5%. I think I mentioned that. And real estate up a little bit too. Everything else was down, and technology really leading the way. The tech sector was down over 5.5% this week. Semiconductors down over almost 5%, 4.8% on the week. And consumer discretionary down almost 5% this week. All of them just taking a big hit. And then gold and silver. Wow. You know, we've been warning you about these metals, folks, for a while. I felt that gold was really going to push down below 4,000. Well, it was down 5% today in a single day. It's now negative on the year. Silver was down 9.9% today. It's down 4.5% on the year. So everybody that was all hot on these metals coming into the year, they have not held up, and they really took a big hit today. So what about the whys? Well, maybe we should talk about the whys for the gold first, since we're talking about it now. This morning, we had a strong jobs number, much stronger than anticipated, much stronger than expected. You say, well, that's a strong jobs number, David. That means the economy's doing good. That should have been good news, right? Well, yeah, the whole scheme of things, you would think so. But remember, folks, we've been talking about inflation. It's been incredibly sticky. The inflation story is concerning, and it's not all oil. We identified that a few weeks ago as well. Inflation is sticky, and it's not just energy driving it. So the economy's hot, jobs are good, and inflation remains sticky. Well, that means that rates might actually go up. And after the jobs number this morning, the market is now pricing in a rate hike before the end of the year. Now, I don't know how likely that's to happen. The new Fed chair has talked about letting this economy run a little hot, letting there be a little inflation so we can grow. We'll have to see, but the market's pricing it in. And then listen, if there's a rate hike, that means the dollar gains strength. When you raise interest rates, you strengthen the dollar. You strengthen the dollar, not so good for gold. And we saw gold down 5% today, silver down 9.9. So that's what's happening there. And then we mentioned Iran. Okay, so that was a big story early in the week. After everything looked all resolved practically last week, dot some I's, cross some T's, it all fell apart as of Monday, and that caused some havoc in the market. And then you may recall, I mentioned in last week's podcast, the tech sector has been so hot. The chips have been so incredibly hot. And all it would take, in my opinion, to pop this balloon, to really send these things down and down hard, would be for one of these chip companies to come out with a forecast that just wasn't as strong as the market wanted, right? Just a little bit less than what the market was looking for. Still good, still positive, still going in the good direction, but not going at the same speed. And I thought this market could react and it could be pretty ugly. Well, that's exactly what happened yesterday. Broadcom, big chip company, reported a great quarter, but the expectations they set, the narrative that they outlined was not the same narrative that it has been the last few quarters as far as the rate of demand increase. It's just not the same as what it has been. It was indication of maybe a little bit of cooling, and boy, did these companies react. AMD, that's when we got in our models, down 11% today. Marvell Technologies down 16% today. I'm going to talk more about Marvell in a moment. Global Foundries, remember this one? We sold this one, sold the whole position 2 weeks ago for $90. Global Foundries was down 10.8% today, okay? And it finished the week at $75. So these stocks that we've been trimming, all moving lower. So that's why we trim when we do it, folks, to lock in some of that profit before the market rips it right out of your hands, because the market does not care about your profit, doesn't care about you, doesn't care about your goals, doesn't care about your future, and it will hurt you if given the opportunity. So it was dishing out some pain today for sure. I mentioned Marvell just a moment ago. Look, we've got a handful of folks in our aggressive models. So we have a huge practice, right? We manage a ton of money, closing on $500 million. But we've only got a handful of people, literally a handful in the aggressive models. They've got Marvell Technologies. So congratulations to you folks. Your stock was up another 30% just this week. At one point, it was up 50% this week. Pulled back some today. And you can thank Jensen Huang for that, the CEO of NVIDIA. He had some nice things to say about Marvell earlier in the week, and the stock just went crazy, just went straight up. So I actually wrote Jensen an email. As you know, we go way back. I bought an NVIDIA video card back in the 90s when I was building a computer. So I'm like, hey, I was an early supporter. Would you mind saying something nice about BIG? We would love to see 50% growth in a single week, but he has yet to write back to me. So hopefully he will get that email and he'll say something about BIG and we'll make the same kind of money too, just on his comments. That's how crazy the market's being right now. Now, I'll tell you this. I talked about the aggressive models. Yes, the aggressive models make a lot of money. They do very well. But I'm proud of the fact that we only have a handful of folks in those models. And I'll tell you why. I've seen time and time again throughout my career where financial advisors, financial advisory firms, they just have way too many clients and far too aggressive allocations, folks that can't handle it. And then when the crap hits the fan, and it always does, it's incredibly disheartening for these folks and causes a lot of damage. I think we do a really good job at narrowing this down. These other firms, they do these romper room type of tactics. You want to drive 55 miles an hour, or would you like to drive 75 miles an hour, or would you like to drive 35 miles an hour? Like, that means something. Like, what in the world does that actually mean to anybody? We like to put numbers to it, right? If you got $1 million, are you going to be okay if it drops to 650,000? Even if it means that you make some more money over the next 10, 15, 20 years? Guess what? Most folks, they're not okay with that. And therefore, most folks are not in the aggressive models. The handful of people that say, yeah, I can handle that, that's where they are, okay? But most folks can't handle that. Anyway, I digress. Let's get back on topic. Bottom line is a lot of stuff moving the markets this week. You've got strong economic data that suggests inflation could be around to stay. which suggests that rates may go up, and that's going to cause some problems. You've got the war in Iran, still an issue. And now you've got the tech story showing some questions here and there. And then we add all of that together. We got one more story we got to talk about today, and that is this IPO thing. Now, I know I've mentioned it a couple times over the last couple of weeks, but I've got to mention it again. I get a lot of emails about it. People are asking about these companies. So here's the thing, folks. Up until this point in time, I have not felt, and you know I've said this, I have not felt that this big move in the market, this big AI-driven move, has completely correlated to the 1990s tech bubble, okay? It's not looked the same. There's been a couple of things that are a little similar, a little reminiscent, but it hasn't looked like the tech bubble to me. And you know why? Because the tech bubble, there were companies that weren't making any money that were going through the roof, going up like crazy, up 200, 300, 400, 500%. Companies were just adding .com, just adding a .com to their company name, and a stock would go up 100% the next day, okay? That's what was going on during the tech bubble. And this has been legit. These are big companies that make money, companies like Google and Microsoft and Meta, Facebook, and NVIDIA. These companies are huge. They've got revenues, they've got cash, they've got real money, and they're going up like crazy. But guess what? They're making lots of money, and it's legit. It's not like the tech bubble. The analogy I used to use during the tech bubble, I'm dating this time a little bit. Stick with me on the pricing here. But I said, it's like going to a soda machine and buying a can of soda. Now, back then it was 50 cents for a can, right? I said, so people are going to a soda machine. Instead of putting in 50 cents, they were putting in $5 for a can of soda, thinking they're going to turn around and sell it for $10, right? So they put in the $5, they got the can of soda, and once they got it, they found out there was no soda in the can. The can was empty. So not only was it not worth the $5, it wasn't even worth the 50 cents that they would normally put in to get that same can. That was the tech bubble in a nutshell. People were buying high, hoping to sell higher. And that's not how the game is played, people. You buy low and you sell high. They were buying high and hoping to sell higher. Now, here's the problem that I've got right now. Now things are starting to look like the tech bubble. And I'll tell you why. IPO frenzy. I mean, SpaceX gave the numbers this week. They're going to come out at $1.75 trillion next week. That's how they're going to come to the market. $1.75 trillion. They're going to be the sixth largest company in the country on their IPO date. And how much money did they make last quarter? They didn't. They lost $4 billion. They only had $18 billion in revenue for the whole year last year, only $18 billion. And they're coming to the market at 97 times their revenue. I mean, that's insane. And look, OpenAI, Anthropic, it's all the same story. These companies are coming to the market as trillion-dollar companies. They're not making any money. That, my friends, is reminiscent of the tech bubble. That is the empty soda can. Now, look, some of those companies back in the tech bubble ended up becoming amazing companies. Companies like Amazon and Cisco, et cetera. Same thing's going to happen here, but I'm not going to buy these things at these prices. No way. I'm not interested in these prices at all, not even the slightest. Now, there's going to be some interesting things that could drive these stocks higher out of the gate. There's all kinds of handcuffs being put on this SpaceX IPO. Customers aren't going to be able to sell. It's being added to one of the NASDAQ indexes on day one. So all the index companies are going to have to buy the stock on the market. So there's going to be some things that are going to support the stock initially. But I tell you what, I'd be watching out moving forward, because when these lockups expire and people are allowed to sell, I think you're going to see some probably heavy selling on that stock at some point. Look, I think we'll own it someday. It's probably going to be a great business, but we're not going to own it next week. I've got no interest in it. I'm going to wait for a better price. But this is concerning to me because it's very reminiscent to me of the late 90s and the tech bubble. Other than that, but keeping my eyes on Bitcoin, we don't invest in it. I don't really believe in the valuation of Bitcoin, but I have found it to be a really good tool to give me some insights into the market. When Bitcoin falls, it usually falls pretty hard, and it falls before the market, and the market usually follows suit. And then the same can be said on the other side. Bitcoin tends to rise, and then the market follows suit. Bitcoin, folks, is getting absolutely decimated, absolutely crushed. I was watching earlier this week. I was like, boy, I tell you what, I'm surprised the market's going up with Bitcoin getting hammered like this. And then today on Friday, that whole thing turned around. Now they're moving the same direction. So we'll be watching that pretty close as well. And then to wrap up, one of our top technicians reached out to me this afternoon. folks over at Fairlead Strategies. You see them on CNBC every now and then. Got an email this afternoon saying, look, the S&P caused some real damage today. I've been watching these technicals, and look, I noticed that the market indicators were flashing sell signals the last few weeks. That's why I've been so aggressive at trimming some of these holdings back. It looks like some damage was caused today. And if this market does not rebound pretty hard next week, then we could be in store for something a little bit bigger here in regards to a correction. But no worries, we're positioned well for it. We've done a lot of trimming. We've taken a lot of money out of this market. We've tucked it away in other places. So we've got some money in safer spots that we can utilize or do some buying if the opportunities arise. So be watching everything really close and guide us all through this. Look, the market might rebound next week. This might just been a blip on the screen. Could have been an overreaction to Broadcom. Could have been a little overreaction to this jobs number. Like I said, if we don't get a recovery, a strong recovery next week, then we could be in store for a little bit bigger drawdown here in the market. We'll be watching it all real close. So I'm going to go ahead and wrap up. Between now and next week, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Retire a little early, buy that big RV, travel the country. You know, we've had clients that have done that, done it for years. You know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.